Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we are up 1% and we have about 2 hours left in trading. On the 1 hour chart we are touching the overbought RSI, and if we expand out to the 4 hour chart we are very close to overbought RSI as well, and we also have the 4 hour MACD turning positive. On the daily chart we start to see a possible convergence shaping or in play. And as for the daily RSI, is nearing overbought RSI as well. And over here, I do see we made two gaps, one between December 2nd and December 3rd, and another gap between December 3rd and December 4th. So there is a gap in between those price. We made a nice reversal after dipping below the 18-day moving average, this purple line. And I do see a possible retracement back to fill in this gap where we left off overnight. So there is a possibility, a very good possibility, where we may come back to that price, which is roughly around $309.50. And as for resistance, the all-time high back in November 27 at the price of $315.48. We are very near that. We may possibly breach that this or even today or even coming days. So if we were to move down lower, that price movement is roughly around, if we expand out, so that price movement is roughly around 1.9% to the downside, and to the upside it is around 19 or 20 basis points, so not much to the upside. We are very close to all-time highs. So the forecast model is now available in the link below, so do check it out for the S&P 500. And if you configure the settings, you get all the models that we do not go over with in the forecast or in this video, so do check it out. So back to the forecast model, I'll go day by day where the S&P 500 will head to next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to March 28th to June 24th, 2014. So let me point out why these two charts are similar. So what we have here in the beginning of the trend, we started off touching the upper Bollinger Band, and we'll mark that as green. And then next we proceeded to head down lower to touch the bottom Bollinger Band. And after that we see a nice trend for several weeks, averaging above the middle Bollinger Band at this instance. And then we took a slight dip below the middle Bollinger Band right towards the end, and after that we saw a reversal today, and this will be considered touching the upper Bollinger Band. So we start to see a similar pattern here as well. We see start off on the upper Bollinger Band, and then it proceeded to touch the bottom Bollinger Band. And then after that, we average above the middle Bollinger Band for several days right here, or I should say several weeks. And then after averaging upper middle Bollinger Band, we see it revert back to mean to touch the middle Bollinger Band. And right at the very end, we see it touch the upper Bollinger Band, and that is where we are currently at the current trend. So we have those points to keep in mind. We have about 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was March 28th to June 24th, 2014. Back then, the S&P 500 was up around 1.8%. So there's a possibility the S&P 500 may head up higher, reaching another all-time high in next coming days. So again, this forecast model is now available in the link below, so do check it out. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.